What's the Fed's next move? Will it be a larger hike or a smaller one? That's the question causing ripples in financial markets worldwide. The Federal Reserve's interest rate decisions are a big deal. They directly impact borrowing costs, investments, and the overall economic activity on a global scale. And right now, there's a buzz of speculation in the air. Some investors are starting to think that the Fed might need to be more aggressive than previously thought in order to keep inflation in check. This speculation is causing a stir, leading to volatility in stocks and bonds. But why would the Fed consider a larger than expected hike? There are a few key arguments. First, there's the issue of stubborn inflation. Despite previous rate hikes, inflation remains higher than the Fed's target. This could suggest that stronger measures are necessary to bring it under control. The second argument revolves around the strength of the U.S. economy. There are signs of resilience that could potentially allow the Fed to tighten policy more aggressively without derailing growth. This is no small feat. It's like trying to slow down a speeding car without causing a crash. Then there's the argument of market expectations. Some believe that the markets have already priced in a larger hike. In other words, investors have already factored in a larger rate increase into their decisions, so a larger hike wouldn't necessarily cause major disruptions. But as with any story, there are two sides. While there are compelling arguments for a larger hike, there are also reasons to consider a smaller one. The question of the Fed's next move is a balancing act between controlling inflation and maintaining economic growth. It's a guessing game that has everyone from Wall Street to Main Street on the edge of their seats. So there are compelling reasons for a larger hike. But what about the other side of the debate? While some argue for a more aggressive approach, others caution against it. Here's why. Firstly, growth concerns. An aggressive tightening of monetary policy could rein in economic growth, potentially leading us into a recession. While the economy is showing signs of resilience, it's a delicate balance that could easily be upset by a larger than expected rate hike. Secondly, financial stability. Higher rates mean higher borrowing costs. This could strain borrowers, both individuals and businesses, potentially triggering financial instability. We've seen it before, and nobody wants a repeat of that scenario. Lastly, global risks. We live in an interconnected world, and external factors like the ongoing conflict in Ukraine and slowing global growth urge caution against overly aggressive rate hikes. These factors are beyond the Fed's control, but they can't afford to ignore them. Clearly, both sides have their merits. So, what should we watch for in the coming weeks? In this guessing game, every little clue counts. Here's what to keep an eye on. Upcoming economic data, particularly key inflation and employment reports, can sway the Fed's decision. Statements from Fed officials also offer valuable insight into their stance. The market's reaction to these developments can be a barometer of investor confidence and hint at possible economic impacts. Yet, the Fed's decision won't be made in a vacuum. Broader economic concerns, such as fears of a potential recession, both domestically and globally, play a part. International factors, like the monetary policies of other central banks, can also influence the Fed's actions. In this complex situation, staying informed is crucial. Keep a close eye on news reports, Fed statements, and economic data. Understanding the potential implications for your investments and financial planning can help you navigate these uncertain times.